Reaching the age of 68 brings a profound shift in how one views the world of finance, moving away from the aggressive growth strategies of youth toward a philosophy rooted in resilience and survival. Having steered JPMorgan Chase through 3 massive financial crises, I've witnessed firsthand how quickly entire asset classes can vanish, leaving those who are unprepared with nothing but hard lessons. When you are in your 40s, time is your greatest ally. A market crash is merely a temporary setback because you have decades of earning potential ahead of you to repair the damage. You can afford to be bold, to speculate, and to treat losses as the cost of admission for long-term wealth building. However, once you cross the threshold of 60, the landscape changes fundamentally because the luxury of time has evaporated. At this stage, you are no longer building a mountain of capital. You are living on the peak you've already scaled. The mission shifts from the pursuit of riches to the defense of wealth. It is about safeguarding a lifetime of labor to ensure your standard of living remains untouched by the volatile whims of the market. Over decades of managing wealth for thousands of families, I have seen the same story play out repeatedly. Those who thrive in their later years are not the ones who chase the highest yields or the latest technological fads, but those who embraced a strategy built on 3 specific, time-tested pillars of stability. We must be honest about the reality of risk. No investment is entirely devoid of it. Cash is eroded by the relentless creep of inflation. Government bonds fluctuate alongside interest rates, and even the most established stocks can stumble. True safety in your 60s is defined by 3 non-negotiable traits: the preservation of your initial capital, the generation of a consistent and predictable income stream, and a proven track record of weathering multiple economic storms without breaking. This brings us to the first essential foundation for any serious retirement portfolio: U.S. Treasury securities, and specifically Treasury inflation protected securities, or TIPS. To many, government bonds seem uninspired or even boring compared to the high-octane world of tech stocks or crypto, but in the realm of retirement, boring is exactly what you should crave. Predictability is the ultimate form of power. When you are no longer receiving a paycheck, TIPS are backed by the full faith and credit of the United States, a nation that has never once defaulted on its debt in its 2.5-century history. Despite political noise or national debt concerns, the U.S. remains the world's reserve currency powerhouse with an unmatched military and political infrastructure. When the world enters a state of panic, the U.S. government still pays its bondholders, making this the most secure bedrock available. The critical advantage of TIPS, which makes them indispensable for anyone in their 60s, is their built-in defense mechanism against the silent erosion caused by inflation. Unlike a standard fixed income bond, the principal value of a TIPS bond moves in tandem with the consumer price index. If the cost of living jumps by 5%, your investment base grows by that same 5%. This is a vital shield because inflation is the single most dangerous predator of a fixed income lifestyle. Even a modest 3% annual increase in prices will strip away half of your purchasing power over the course of a typical 20-year retirement. For a retiree who begins their journey at 65, failing to account for this can lead to a standard of living that is halved by the time they reach 88. By utilizing these securities, your income is effectively indexed to the real world, ensuring that your ability to afford basic necessities from healthcare to groceries remains constant regardless of how fast prices rise. Furthermore, we are currently in a unique window where TIPS are offering attractive real yields returns that exist above the rate of inflation. For much of the last decade, we lived in an era of negative real yields, where you essentially paid the government to hold your wealth. But today, you can secure a genuine return of 2% to 2.5% above the inflation rate. At JPMorgan, my standard recommendation for those over 60 is to anchor between 40% and 60% of their total portfolio in these instruments. The exact percentage depends on your personal safety net. If you are fortunate enough to have a robust pension or high Social Security benefits, you can lean toward the lower end. But if your private investments are your primary engine for survival, pushing toward 60% provides the necessary peace of mind. Moving beyond government debt, the second pillar of a secure retirement strategy involves high-grade corporate bonds from the world's most financially resilient companies. While they carry slightly more credit risk than the U.S. Treasury, they compensate for it by providing higher yields that can meaningfully boost your quality of life. The secret here is extreme selectivity. You aren't just buying debt, you are lending money to institutions that must have bulletproof balance sheets and predictable cash flows. Our analysts focus on blue-chip giants that dominate their respective markets entities, like Johnson & Johnson, which has raised its dividend for nearly 6 decades, or Microsoft with its massive cloud-based cash engine, and Coca-Cola, a brand so global it is practically irreplaceable. These corporations offer bonds that typically pay 1% to 2% more than government debt while maintaining a default risk that is near zero. For a retiree, that extra margin of income is the difference between just getting by and truly enjoying your golden years. I generally suggest an allocation of 15% to 25% here, spread across different sectors, to ensure that a downturn in one industry doesn't destabilize your entire income stream. The third essential component for investors who have crossed the 60-year mark involves shifting focus toward high-quality, dividend-paying stock. I recognize that for many, the very word stock implies a level of volatility that feels incompatible with safety, especially when market crashes can erase a third of a portfolio's value in a matter of weeks. However, when we narrow our focus to a very specific subset of the market companies with defensive business models and decades of consistent payouts, the risk profile changes dramatically. These are not speculative bets on future growth. They are stakes in essential businesses that provide the goods and services humanity requires, regardless of the economic climate. Think of the utilities that keep the lights on and the water running, or the consumer staple giants that produce the food and household products found in every pantry. These sectors possess a natural resilience because their earnings remain stable even during the deepest recessions, allowing them to provide a reliable stream of dividend income that acts as a psychological and financial buffer against price fluctuation. Take a company like Procter & Gamble, which has not only paid dividends for over 13 decades, but has increased those payments for 67 consecutive years. People do not stop buying soap or toothpaste because the stock market is down. Similarly, NextEra Energy operates in a regulated environment where the demand for electricity remains constant, providing the kind of predictable cash flow that has fueled 28 years of dividend growth. These investments serve a dual purpose. They offer immediate cash flow that often yields 3% to 5%, far outperforming traditional savings, and they provide a structural hedge against inflation because these companies possess the pricing power to pass rising costs on to consumers. I typically advise that retirees allocate between 20% and 30% of their wealth here, provided they remain disciplined enough to ignore short-term price swings. The 2008 financial crisis and the 2020 pandemic proved that even the sturdiest stocks can drop temporarily, but if you own high-quality assets and are not forced to sell during a panic, you can simply continue collecting your checks while waiting for the inevitable recovery. The danger at this age isn't the market's movement, it is the investor's reaction to it. By staying focused on the income rather than the ticker price, you can harness the growth of the corporate world without exposing your basic security to unnecessary peril. Shutterstock, as we refine these strategies, it is equally important to identify the pitfalls that frequently derail even the most well-intentioned retirement plans. The most common error I see among those over 60 is the desperate reach for yield. When interest rates are low, retirees often grow impatient with the modest returns of safe havens and begin migrating toward riskier assets like junk bonds, preferred stocks from unstable companies, or complex real estate partnership. It is a seductive trap, but the math is unforgiving. A higher yield is simply the market's way of pricing in a higher probability of loss. I have spent years talking clients out of lending money to companies I wouldn't trust with a dime, simply because they were blinded by an extra 2% in annual return. When you are living on a finite nest egg, it is far better to earn a secure 3% than to gamble for 6% and risk a 30% collapse of your principal. This leads directly into the second major mistake, the myth of market timing. Many investors believe they can outsmart the collective wisdom of the market by jumping in and out based on headlines. In reality, this almost always results in selling at the bottom and buying back at the top. Even with a global team of analysts and the most sophisticated models at JPMorgan, we know that consistent market timing is impossible. For an individual, it is a guaranteed recipe for financial ruin. Furthermore, we must guard against the overconfidence that often comes with a successful career. Being a brilliant doctor, engineer, or business owner does not automatically translate to being a master of public markets. Investing is a distinct discipline requiring deep technical knowledge of macroeconomics and valuation. Yet I see many retirees treat their life savings like a hobby, chasing hot sectors or picking individual stocks without a safety net. This lack of professional rigor often leads to the fourth mistake, a failure to diversify. Whether it's holding too much stock in a former employer or ignoring international markets entirely, an undiversified portfolio is a fragile one. Finally, there is the often overlooked impact of taxes. How you structure your withdrawals and where you hold specific assets, whether in a taxable account or a tax-deferred vehicle like an IRA, can be just as important as the investments themselves. As you transition into a lower tax bracket in retirement, failing to optimize for things like Roth conversions can cost you a fortune in unnecessary payments to the government. Beyond the mechanics of the portfolio, we must confront the broader economic forces that will define the next 2 decades for anyone currently over 60. We are transitioning out of a long era of low inflation into a period where structural pressures driven by deglobalization, an aging global workforce, and unprecedented levels of government debt will keep prices higher for longer. This is a direct threat to anyone on a fixed income, reinforcing why a combination of inflation-protected bonds and dividend-growing stocks is no longer optional. It is a survival requirement. We must also acknowledge longevity risk, which is the very real possibility that you might outlive your money. A healthy individual at 65 today has a significant chance of reaching 95, meaning your capital may need to work for 30 years or more without a single new paycheck coming in to replenish it. This creates a delicate balancing act where you must remain conservative enough to avoid a catastrophic loss, yet aggressive enough to ensure your purchasing power doesn't wither away. When you factor in the accelerating costs of healthcare, which historically rise faster than the general cost of living, the need for a disciplined, high-liquidity strategy becomes even more urgent. To put this into practice, start by calculating your survival budget, the absolute minimum required for housing, food, and medicine, and ensure this is covered entirely by the most secure government and corporate debt. Any lifestyle desires, such as travel or legacy gifts, can then be funded by the more variable dividend income from your stockholding. It is vital to maintain a liquid emergency fund of up to 12 months in a high-yield account so that you are never forced to sell your long-term assets during a market dip. Rebalance your holdings once or twice a year to ensure your risk hasn't crept too high during a bull market, and if the complexity feels overwhelming, seek out a fee-only fiduciary who is legally bound to put your interests first. The traditional 4% withdrawal rule is likely too optimistic for today's world. Aiming for 3 to 3.5% provides a much safer margin for error. Above all, tune out the constant noise of the financial media, which profits from your panic and excitement. Your goal is not to beat the market or find the next unicorn. It is to build a fortress that allows you to sleep soundly, knowing your lifestyle is protected by the same principles that have sustained wealth through every war, recession, and crisis of the last century. Choosing these proven paths might not make for exciting dinner conversation, but it will ensure that your financial security remains as solid as the life you've spent decades building.